What's going on, everybody? Due to a lot of confusion and a lot of questions regarding AKAO stock from the last few days, today's 12/15/2016, I wanted to do a brief video on the situation with it. It's jumped up huge the last few days, more than 200%, on news of positive phase 3 results for the company, and it's blasted up on huge volume. And the move started a few days ago. I believe it was on the 12th. Yeah, it was on December 12th. Jumped up huge, kind of came back down some, popped back up again, and it's kind of settled down around $14 a share after hours today. The first thing I wanted to go ahead and jump into, because there's a lot of concern with it, is the public offering of shares that they recently had after the big move. Now, generally, a public offering is not, particularly a good thing. If the share price is a lot lower than where the current price in the stock is, it's obviously not going to be good. Generally, if the offering price is around, the vicinity of the same same price that currently the stock is, it's not going to be as big a deal. But in this case, you really have to be careful. You have to read through the Form 424B5. They put out two of them recently, just the other day. They put one out, then they put out a new one today at 4:06 p.m. You can see it right here. So I'm going to pull that up, and I want to go through this, and I want to show you guys some things I found when I read through the fine details. All right, so let's pull this up. Okay, so off the top, as you can imagine, the company is going to want it to sound like that the offering price is reasonable. That way, they can keep the stock move going. It doesn't crush it. Investors and traders don't feel like they're getting ripped off. So, they post up here that there's 6,500 shares that are supposedly going to be offered at the price of $13.50, which you can see right here. But there's some problems with this, though. There's some problems with this once you dig in and look at the fine print. Okay, so there's a few different things in here that I want you guys to see. Now, most people, they don't want to run through all this mumbo jumbo, and that's exactly how they like it. They make it, they put as much in there as possible to make it complicated, make it so people don't want to read through everything. It's a lot of junk, and therefore most people don't read through it, and they don't really know what's going on. So off the top, it looks like $13.50 a share is the offering price, which is a little bit lower, about 65 cents or so lower than where the stock closed today and where it is after hours. Okay, so off the top, it doesn't sound that bad, but let's dig in here a little further. All right, when you come down and start digging in a little bit, let me find this. What am I looking for here? Okay, we are looking for, okay, first thing everybody should read is right here. It's down S8, risks related to our business. All right, and I know this is going to be kind of a lot of stuff to go through, but I'm going to read it all because I want to make sure I go through everything I think is important. So it might take a little bit of time, but bear with me. Our business is subject to numerous risks, as more fully described in the section entitled Risk Factors and discussed under the section captioned Risk Factors, blah, 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 blah. First thing, we have a limited operating history, have incurred net losses in each year since our inception, and anticipate that we will continue to incur significant losses for the foreseeable future. Okay, that is not really a positive thing right there. All right, significant losses for the foreseeable future. We are substantially dependent on the success of our lead product candidate, plasmomycin. Okay, So if for some reason that did not work out, which right now it's only phase 3 results, this is no guarantee that this is going to work out. So they're substantially dependent on the success of that lead product. Another thing that's not good. We will need substantial additional funding. Okay, we already know they need money badly, obviously. As soon as the stock jumped up big, they were offering shares. And when I dig through a little further, I'm going to show you where they actually might be offering even more, as much to double what they've already offered. Okay, we may not be able to obtain regulatory approval for plazomicin or any other product candidate, or for our in vitro assay for plazomicin. Even if plazomicin or any other product candidate obtains regulatory approval, it may not achieve the level of market acceptance by physicians, patients, hospitals, third-party payers, and others in the medical community necessary for commercial success. So even if it is approved, there's no guarantee that there's going to be commercial success. So it's a long way off that this situation ever is to become turned into dollars. Okay, it's still a long way off. And the stock having a current market cap of around 400 million is pretty. That's a pretty big market cap considering these facts. We may not be able to obtain adequate coverage and reimbursement from government and third-party payers for plazomicin. We rely on third-party contract manufacturing organizations to manufacture and supply plazomicin and other product candidates for us, as well as certain raw materials used in production thereof. If one of our suppliers or manufacturers fails to perform adequately, we may be required to incur significant delays and costs to find new suppliers or manufacturers. So there's a lot of problems you can see that they still have to get through to make this thing, to be able to commercialize this product. For use of government funding adds uncertainty to our research and commercialization efforts and subject us to additional requirements and costs. If our intellectual property for plazomicin or any future product candidate is not adequate, we may not be able to compete effectively. So even if the FDA approves it, even if they're able to set it up to put it out commercially, there's still no guarantee they're even going to be able to compete effectively. And from what I understand, there is a lot of competition. They're not the only ones doing this. Okay? So this is just something important that you got to think about right here when you're valuing the stock and deciding if you should go long or if you should short this thing. All right, let me scroll down here to the next thing, which is actually right here. Okay. This is really important right here when you get into the fine details. The offering. Okay? Common stock offered 6.5 million shares. Okay, cool. But let's dig in here further. Granted underwriters a 30-day option to purchase up to additional 975,000 shares. Okay. Now, the number of share common stock be outstanding after offered is based on 27,451,400 shares of common stock outstanding. Excludes the following in each case as of such date: 3.4 million shares of common stock issuable upon exercise of stock options outstanding, blah, 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 at a weighted average exercise of $6.37 per share. Okay. 500 plus thousand shares, restricted stock units outstanding. 600,000 pursuant future awards under equity incentive award plan. Okay, let's look through here. Employee stock purchase plan, 300,000. Basically 200,000. Employment consentment incentive plan, and 2 million shares at a weighted average exercise price of $3.78 per share. So you've got 3 million shares here at $6.37 a share. You've got 2 million shares at $3.78 per share. Okay, something that wasn't exactly advertised. It's kind of buried in here. All right. Let's go down here a little further. Okay, risk factors. Let's see. All right, this is important too. A lot of people don't realize, regardless of what the price is for the offering, when a company puts out additional shares, it still is going to dilute the investors' shares. Okay? It's still going to dilute the value. That's what people don't think about. It's not just about, is the offering price, higher or lower or the same as what the current stock price is. It's also about dilution. Okay? Your shares are going to be diluted and become less valuable when companies offer more shares to the public. All right, here it says right here, if you purchase our common stock in this offering, you will incur immediate and substantial dilution in the book value of your shares. You will experience further dilution if we issue additional equity securities in the future, which they might do. Okay? Investors purchasing shares of common stock in this offering will pay a price per share that substantially exceeds the as-adjusted book value per share of our tangible assets after subtracting our liabilities. As a result, investors purchasing shares of common stock in this offering will incur immediate dilution of $10.17 per share, based on a public offering price of $13.50 per share, and our as adjusted net tangible book value as of September 30, 2016, after giving effect to the offering. For more information, see dilution. This dilution is due to substantially lower price paid by our investors who purchased shares prior to this offering as compared to the price offered to the public in this offering, and the exercise of stock options granted to our employees. In addition, as of September 30th, we had outstanding 500,000 restricted stock units and options. Blah, blah, blah. Let's see. Result in additional dilution. As a result of the dilution to investors purchasing shares in this offering, investors may receive significantly less than the purchase price paid in this offering, if anything, in the event of our liquidation. All right. So yeah, this is super important to understand before you're investing in the stock, trading in the stock, going long, whatever you're doing. You've just got to know these things. And believe me, they bury this stuff in here. They don't want you to see it. That's why there's so much nonsense in here. They don't want you to be able to find this stuff. They focus on just the general, hey, we're offering shares at $13.50, and they just figure you won't read the rest. And most people don't. Most people don't read it. Okay, let's see what else we have here. Okay, S13. Here's another very important part of this form. Here you go. And again, bear with me. I know reading through this is taking a lot of time. I know it's kind of a pain to listen to everything, but it's important. All right, sales of a substantial number of shares of our common stock in the public market could cause our stock price to fall. If our existing stockholders sell or indicate an intention to sell substantial amounts of our common stock in the public market, the market price of our common stock could decline. Based upon the number of shares common stock outstanding, I'm going to try not to have to read as much of this, as little as I possibly can. On April 7th, we entered a common stock sales agreement with Cohen & Company, under which we may offer and sell our common stock having aggregate sales proceeds of up to $30 million from time to time through our sales agent. As of the date of this prospectus supplement, common stock for aggregate proceeds $24 million remained available to be sold under this facility. In connection with this offer, we've agreed to utilize the ATM sales agreement from the date of this prospectus supplement, continue through and including the date of 6 days after. Following the 60-day period, we may offer and sell our common stock, and such sales could cause our stock price to fall. Certain holders of common stock are entitled to rights with respect to registration of their shares under all this. Let's see. Could have a material adverse effect on the trading price of our common stock. So they're pretty much warning you that with everything they're doing, the stock price could definitely fall. And that's what it's most likely going to do. Our stock price is volatile, and our stockholders may not be able to resell shares of our common stock at or above the price they paid. And these are just some examples of reasons why they may not be able to sell the stock for higher. Delays in commercialization, delays in trial programs, Announcements to commercialization, any need to suspend or discontinue clinical trials due to side effects, capital fundraising, manufacturing issues, commercial success. I mean, so, when you really look through this, you really get a taste of what all they really have to get done to really start making money from the product. It's not even close yet to where it needs to be to start showing returns. Okay. Alright, so let's go down to S17, or the S17 area. Here we go. Okay, dilution. This is very important to read again. Dilution. S17. Okay. If you invest in our common stock in this offering, your interest will be immediately diluted to the extent of the difference between the public offering price per share of our common stock in this offering and the net tangible book value per share of our common stock after this offering. As of September 30th, 2016, we had a historical net tangible book value of $31 million, or $1.13 per share of common stock. Our net tangible book value represents total tangible assets less total liabilities and convertible preferred stock, all dividended by the number of shares of common stock outstanding on September 30th. After giving effect to the issuance and sale of the new 6.5 million shares of common stock in this public offering at $13.50 per share, and after deducting the underwriting discounts and commissions and estimated aggregate offering expenses payable by us, our as adjusted net tangible book value as of September 30th, 2016 would have been approximately $113 million, or $3.33 per share. I want to stress that again. $3.33 per share. The stock is currently trading at 4 times that, more than 4 times, at $14 plus. Okay? This represents an immediate increase in as adjusted net tangible book value of $2.20 per share to existing stockholders, and an immediate dilution in net tangible book value of $10.17 per share. That's how much it's being diluted to new investors purchasing our common stock in this offering. The following table illustrates the dilution on per share. Okay, so public offering share price $13.50. Historical net tangible book value per share was $1.13 as of September 30th. Increase per share attributable to new investors $2.20. At adjusted net tangible book value per share as of September 30th, 2016, after giving effect to this offering, so this is talking about now, $3.33 per share. Okay? Again, I want to stress the stock is at $14, and they're saying the adjusted net tangible book value per share after giving effect to this offering is $3.33 a share. Okay? Dilution per share to new investors purchasing our common stock in this offering, $10.17. Now, it's funny, they didn't make this very obvious, did they? All they said up top, which is all that anyone sees, is $13.50 a share, is the offering price. But when you look into it, you're getting diluted $10.17, and you're looking at $3.33. Unbelievable. Unbelievable. All right. I think that's everything that I want. The main. You really should read through this whole thing really carefully. I know it's a lot of stuff, but that was the main stuff I wanted you to see. Okay. Let me just check here, make sure there's nothing else. Just showing the same thing again. I don't want to read too much more to you guys because I know I've already been reading a lot. Let's see. This shows you who the underwriters were. Leerink Partners, the company, Security, SunTrust. Shows you those people. Okay. Shows you the commissions, 400,000. It shows you all the fees. Let's see. Oh, there's one more thing I wanted to mention. Let me find it real quick. I forget which one it was here. Let me see. Here you go. Yeah, this is important too. Okay. $150 million. Common stock, preferred stock, debt securities. We may offer and sell up to $150 million in the aggregate of the securities identified above from time to time in one or more offerings. This prospectus provides you with general description of securities. So it looks to me like they're saying that they might be offering even more shares in the future, because right now I think it was only 86 million was the total offering. So that would be double the current amount. So that sounds to me like they potentially could be offering even more shares, maybe twice what they've already offered, which would cause even more dilution in the value of the stock for shareholders. And that's not good. And they said, they say they need money. As I read before in the risks, they said they need money badly, so obviously there's a good chance of this happening again. So if you're long, you got to think about this kind of stuff. Each time we offer and sell securities, we will provide a supplement of this prospectus. Yeah, basically they're saying they may offer more shares. Okay. All right. I think that's enough from the Form 424B5. I think that's all you guys need to see. So let's look at some more things. I'll go ahead and exit out of this, and let's go through a few more things. I want to go over the chart as well, but I wanted to show you something I call the Wall Street Iron Triangle, and I kind of came up with this theory, this idea myself. Iron Triangle, something here for like politicians, interest groups, and things like that. There's some iron triangle examples out there, but I came up with one for Wall Street specifically. So what I did is I made this picture, because this is what I believe to be going on. And what I mean by the Wall Street Iron Triangle is it's three different groups that work together in collaboration for their own benefit. And basically the money gets transferred from retail traders like us, investors like us, to those involved in the Iron Triangle. Okay? The whales at the top are the hedge funds, the big banks, the large investors, institutions, and big businesses. Okay, then you've got the media as part of the triangle, the TV networks, CNBC, Fox, CNN, the Wall Street channels, all these channels pushing their agendas, newspapers, online publications, anything Wall Street related, Benzinga, Seeking Alpha, all the different publications out there, magazines, social media, things like Facebook and all the different social media sites that are putting out news, and it can influence human psychology basically when it comes to stocks and trading and investing. Then you have insiders, which would be politicians, company executives and employees, and then Wall Street tipsters. So these are the three groups that work together to pump stocks, to push the upgrades, to put out pump articles, and they're all working together. They're all inside. The hedge funds have the hedge funds and the banks. There's no question that they have the ratings puppets in their back pockets. They load up a position. They have the rating puppets put out the articles. They have the the online publications put out the pump articles. They're already in the stock. The retail traders chase the heck out of it when it pops and it gets on our scanner. The retail chasers start loading up, and that's when they sell to us. They sell to us when the stock's already run up. They sell to us, then it dumps, and we're left holding the bag. This is what's happening. And then, of course, they sell short to us at the top when people are chasing, and the newbie traders are chasing the stock high. These institutions are selling to us. selling to the ones who are chasing the top, and they're selling short, and they're making money on the way down. They're making money on the way up with the pumping, and then all of a sudden, when everything seems bullish and everyone's buying, that's when the negative media starts coming out, the downgrades start coming out, and all the baloney that's on the negative side comes out, and then everybody's selling, trying to get out, and they're making money on the downside with the shorts. This is what's happening. This is the Wall Street Iron Triangle. And in my opinion, this is what is happening with AKAO stock. Okay? Up until recently, before the election, the market wasn't nearly as crazy as it's been. So obviously the computer programs, the algorithms have been churning. They've been out of control lately, and they're running. And you can see there's a lot more action in stocks. It's a different market than it was a few weeks ago, bottom line. It's a different market. It's changed. So you have to adapt with the market. Now, so with all these algos run, all these computer programs, stocks are running a lot higher, a lot crazier than they've been. You're seeing these 200, 300% moves, and you weren't seeing those before. And what's funny is you'll start to notice is after a stock like AKO runs up like 200%, all of a sudden you start seeing the upgrades come out. Where have those been? 3 or 4 different upgrades. Then you see the pump articles, places like Seeking Alpha and other places. You see those starting to come out. They weren't coming out before, but now when the market's coming back and all of a sudden you see the stock moving, all of a sudden IPOs are going to start coming out. And, I find it funny because all of a sudden I've seen a lot of Phase 2, Phase 3, Phase 1 results in these bios. It's almost as if the companies were holding back the news, waiting for the market to get better, and then they see something like AKAO happen, and all of a sudden they're coming out putting all these results out and everything. It's really pretty funny if you watch and pay attention. All of a sudden you're seeing a lot more of it. Well, where was it before? The answer is that nothing was happening before, so they didn't want to release it because they knew the stocks weren't going to do much. Same thing with IPOs. IPOs were dead because nothing was moving, so nobody's doing IPOs. So yeah, it's all inside. I mean, that's just how it is. That's Wall Street. So I just want to make that clear. So, and yeah, I really think that AKAO, that this is what's going on. You saw the upgrades. You see the pump articles now, price targets, and obviously somebody, probably some sort of whale, is in this. They want this thing up. They've got their media side of the triangle pushing to help their shares get higher. And of course, the insiders are always giving out tips and whatnot to the hedge funds, and it goes on from there and there. All right, so that's the Wall Street Iron Triangle. Now let's go to a few things I looked at. So here's some examples of some of the upgrades. Here you go, AKAO. Cohen and Company analysts reiterated a buy rating. Okay, here's that. All right, then you go over to the next one. You got, AKO was upgraded by Needham to a buy. Then we go over here and you got analyst AKO stock is worth $15 a share. Well, that's debatable after what I just showed you guys in the Forum 424B5. That's pretty debatable. The stock's worth $15 after what I just showed you. In fact, that's actually laughable. Okay, now let's go to the next one. Okay, I pulled up the street. I like to look at the street just to kind of see what they have stocks rated. And in this case, they have AKO, as I would expect, as a D sell. Terrible. Terrible. A D. And I thought that was interesting. Look at their earnings real quick, and as expected, on a lot of bio-type stocks, there's not going to be much earnings until they commercialize their product and go from there. But as expected, if you look at this, it's nothing special. They don't have a lot of revenues, and you can see their net loss has been increasing. 2015, it was negative 15 million. Jumped to 2016, more than double to 41 million net loss. Okay, so earnings are nothing special. Obviously, I just wanted to point that out. Let's go in here, and here you go. Seeking Alpha, which is definitely very much a pump publication. They have different writers that put out articles, and you can guarantee that when they put out articles like this, of course they're long the stock. I mean, there's not a question. Yes, they're long the stock, and they're trying to get it higher. They're trying to push it higher. It's obvious. Um, so this one right here is talking about some positive stuff about it. I don't have time to read through that. Then you got this guy, Jonathan Faison. That's how you say his name. Long only, of course. Long only. Biotech, of course. This guy's long. A buy after secondary offering. Shares are up 200%. Further gains are probable. Give me a break. This guy's obviously long the stock. He's trying to pump it and get it higher. And I just want everybody to be aware of this kind of stuff. All right, let's look at I call seeking alpha pumping alpha, because that's usually what they're doing. They're usually pumping stocks. So pumping alpha would probably be a more suitable name. Now, Benzinga, this is another pump fest. They're always pumping stuff, different things. This is what I'm talking about in the Iron Triangle online publications that have a lot of followers, a lot of users on the site. They can influence stocks. Definitely, that's part of the Iron Triangle as well, like I mentioned right here in the media side of the triangle. Phase 3 shows best case scenario. I guess they're saying, it sounds like they're saying that they're showing the best possible case, so it might be exaggerating. But yeah, it's another, Benzinga putting something out there. And then I ran across this little article that I thought was interesting, talking about machines are pumping up the volume. And it kind of talks about just what I was talking about earlier, about computer programs and algorithms have obviously jumped into the market a lot more. And we had like a 7 straight day bull run. Today was the first negative day. And that kind of brings me to talking about the Fed. That's another thing to consider. If you're long something right now, we've had a huge bull run the last 7 years. Stocks way up, almost approaching like 20,000, and it's dangerously high. It's dangerously high. We've had a huge run since Trump was elected, and you got to understand that when the market's this high, we don't know. You can't guess the market. You don't know when it's going to stop. But when the market's up this dangerously high, you got to be careful, because it could be looking for a big correction. And we've had a nice run on Trump's honeymoon. But the thing is, with the Feds just now raising rates, that could have a big effect on the market. It could kill it enough to have a big correction. So we have to see. I'm not going to try to guess what's going to happen, but it is definitely possible there could be a big correction on the Fed raising rates for the first time. Or not necessarily the first time, but raising rates and going to raise rates in the future, apparently next year, maybe 3 more times. So the point is that raising rates is a change, and we don't know how the market and traders and investors are going to react. Okay, so I thought that was kind of interesting. All right, now after going through all this, let's go ahead and I want to quickly run through the chart itself. Okay, so being a day trader, I'm always trading charts. I'm always looking at support and resistance. It's very, very important. I get in and out quickly. I buy support, and then I sell resistance. I short resistance, and I cover at support. Or at least I try my best to do that. It doesn't always work that way, but that's what you're after. Okay, so when you look at what I notice is on the 10-year chart, this is a pretty big deal. The 10-year chart. Okay, you can see there's a really strong resistance area. This is almost the max chart. I mean, the max chart, I think the all-time high is around $20. And the 10-year chart is what caught my eye. It's got really, really strong resistance in this 16 area right here. That's real strong. And you can see that's where it stopped so far. That's right where it is. And it's having a tough time getting through. If you look at today, you can see that. It got up there in that area again. This was I think 15 area. Let's look at the 2-day chart. Yeah, you can see that it got up to around exactly that 615 area from that 5-year chart. So right now it's showing strong resistance. And with everything I was showing you in the form 424B5, with the dilution and the book value of the stock, and the fact that the Fed's raising rates, And the fact that this is a strong resistance at 16, I mean, I recommended the other day in a tweet that if you're long on this, I mean, that's awesome. Congratulations, because you made some nice money, but you got to take that profit. You got to lock that green, because if you don't lock that green, this thing could get crushed and drop 50% on selling after such a big move, and then you give back all your profits. So, a lot of people, they think I just short, but I go long too. I go long and I short. I love to short. It's definitely one of my favorite things to do, because I love to short these overblown momentum runners on baloney news. But I also do go long, and if I see a stock is strong and I see strong volume, I'm going to look for the long play as well. Just because I like to short doesn't mean I don't do both. I look for money wherever the opportunity is. Okay, so right now it's showing strong 16 resistance, and it's just, with everything going on that we talked about, I just find it hard to imagine this going any higher. So I'm putting a price target on this stock of $7 a share. I think it could potentially drop 50% in the days or weeks to come, based on everything I was telling you guys earlier. So if you're long, I definitely think you should lock that green, and you should definitely, if you can short, I would definitely look to short this stock. I've got puts, I've got options in this. I've got puts. For those of you who don't know options, basically a put's kind of like shorting. I'm betting this is going to go down, and I have January 20th puts. So I'm betting that in the next few weeks to a month, this thing is going to drop significantly. Okay, especially if everybody who was buying up those shares starts selling them, and the dilution kicks in. That's what happens. It's the stock's going to start to drop. So so that's my take on it. Putting a price target of $7 a share. And now, if you look from a day trader perspective, by the way, I want to say that this thing is really volatile. So that is great. It's exactly what you're looking for when it comes to day trading. I mean, and if you could look like today, and I shorted this a couple times on the pops, but you can see that when it popped, I mean, it's moving big up and down. That's how you make your money. That's what you want. It's kind of scary, but if you can see it you could see it started to show some resistance around this 15. So when it popped up here, I hit it short right here because I saw the resistance from earlier, 15. I didn't think it would break through because I knew the 16 resistance was strong. So I shorted it around this area here, and then I covered around here. And the reason I knew to do it is because when it popped, you could show it showed support here. You could see that the second time, and once it held that, and then it got back up to the resistance here. It's just, I thought that was pretty strong. So you hit it short at resistance. If it goes higher on you, you can potentially add higher to up your average, or you can set a stop a little bit above to protect yourself. But you got to be careful. Don't set it too close, or the algorithms will find your stop and hit it purposely. So watch out for that. So great volatility. And that's what you're looking for. All right. Now, I hope this video was helpful, and as I always say, if you have questions, feel free to email me, bprising1@gmail.com, and feel free to join our trading room. I teach people to trade small cap stocks. We do options as well, puts and calls, and I provide stock alerts, and it's a great group of traders. You'll learn a lot, and you'll have a good time in the process. So email me if you're interested. Check out the website at bprising.com. And thanks so much for watching. Everybody have a good one.